Good morning. Good morning to everybody. Today, so we have two tasks. One is that the review of questions what we have done earlier. The second part at 11 o'clock. So we will be starting our online test. So therefore, first of all that I would like to discuss with you some of the topics that we have covered during this semester. So therefore that I have prepared for you two questions. Under these two questions, so then first question related to the working capital management, what we have discussed. Second question related to the capital budgeting, again what we have discussed earlier, what if analysis. So first of all, we will go to the first question and we will discuss in detail how that we are going to work it out, this particular problem. Now the question number one, it asking, question number one asking what is known as first question, what is the difference between operating cycle and cash cycle? So we have discussed the working capital management. Under the working capital management, now this question related to the calculation of operating cycle and cash cycle. So what is the operating cycle? Operating cycle refers to the time taken, so between, we know that for the production, so purchasing stocks and finally stocks is selling. So difference between purchase of stocks and receivable of cash is known as operating cycle. So then cash cycle, we know that in case of that cash cycle, so we need to discuss before that some of the other aspects as well. So we go that to discuss, then that you will be able to understand. So therefore now we see operating cycle and cash cycle. We know that the primary concern in short-term finance is the firm's short-run operating and financing activities. For a typical manufacturing firm, these short-term activities might consist of the following sequence of events and decisions. So therefore, the operating cycle refers to the what is known as the time taken to acquire inventory and the difference of collecting cash. So therefore, operating cycle is equal to inventory period plus accounts receivable period. Operating cycle is equal to inventory period plus accounts receivable period. Inventory period plus accounts receivable period. Then the second aspect of that is cash cycle. Cash cycle. Hello. නෑ හරි ඒක තමයි පළවෙනි ප්‍රශ්නය අනිවාර්යයි තව ප්‍රශ්න හතරක්. පහයි. ඔව්. ඔව්. අජන්ත අප්සෙට් කියන කමක් නෑනේ. අජන්ත අප්සෙට් කියන්නේ මොකද? අපි බගෙන්න ඕනේ අජන්ත අප්සෙට් කියලා. ඔයා ඒක කතා කරලා. Then cash cycle, we know cash cycle is that what is known as cash cycle related to the time period hello විශ්වවිද්‍යාලය හොදන මුළු පේපර් සීරීස් එකක් ඕක විතරක් නේ ඕක විතරක් මම පෙන්නන්නම් මම වෙනම අපි සාකච්ඡා කරන ඩිපාර්ට්මන්ට් වලට එක්ක විශ්වවිද්‍යාලේ ප්‍රශ්න නෙමෙයි මගේ ප්‍රශ්න ඔයාලගේ ප්‍රශ්න නෙමෙයි cash cycle refers to the difference between operating cycle and accounts payable. Operating cycle and accounts payable. So therefore, that we go to solve the question. what we have in hand. So therefore I synchronize between these two. Now following information is extracted from the balance sheet of the Axiata PLC. Inventory, accounts receivable, accounts payable. So given the amounts, so therefore as per the most recent income statement, you are provided with the following information. Net sales 23,000 and cost of goods sold is 16,400. You are required to first one calculate inventory turnover, inventory period, receivables turnover and receivables period and the operating cycle. Number 2, cash cycle of the above company. And C, identify and explain three alternative current asset investment policies and depict how those policies affect liquidity, profitability and risk of a company. So we will consider the first one, the part B. Now calculate inventory turnover, inventory period, receivables turnover and receivables period and the operating cycle. Now what is known as inventory period. Now our task is to calculate the operating cycle. Final task is operating cycle calculation. So therefore operating cycle calculation, first of all we need the inventory period. Now therefore what we need, first of all we need to calculate inventory turnover. Inventory turnover is obtained or calculated cost of goods sold divided by average inventory. Cost of goods sold given 16,400. 16,400. So inventory turnover is equal to cost of goods sold divided by average inventory. So cost of goods sold, we'll see the again by going to this one. Cost of goods sold is 16,400. It's 16,400. This one divided by average inventory. Average inventory is, we have 4,000 plus 6,000 divided by 2. 4,000 plus 6,000 divided by 2. So 4,000 plus 6,000 divided by 2. So therefore it's 16,400 divided by 5,000. So the answer is 16,400 divided by 5000. 3.28 times. Now we interpret the same as well. Loosely speaking, this tells us that we bought and sold off our inventory 3.28 times during the year. This means that on average we held 3.28 times. So therefore, leading to the second calculation, what is known as, we need to calculate inventory period. Inventory period. Inventory period is equal to 365 divided by inventory turnover. So therefore 365 divided by 3.28. 365 divided by 3.28. So therefore 365 divided by 3.28 is equal to roughly 111.3 days. So therefore inventory period is 111 days. Inventory turnover is 3.28 times. So what does it mean? Second one, what is called inventory period. It means that on average inventory is set for 111 days in the stores. So therefore this is that the second calculation. Third one, asking the question what is known as the receivables turnover and receivables period. Receivables turnover and receivable period. Now we go to calculate what is known as receivables period. Receivables turnover first. Receivables turnover. Receivables turnover is equal to, we know that, credit sales divided by average accounts receivable. Average accounts receivable. Therefore, we need to obtain credit sales, average accounts receivable. So we go to the sum. We will find account receivable is credit sales, net sales here given 23,000. 23,000. Account receivable 3,200, 4,000. So 23,000 We go to the 23,000 divided by what is known as average account receivable. Average account receivable is given over here. $3,200 plus 4,000 divided by 2. 32 divided by account receivable, average account receivables. We know that 3,200 plus 4,000. So this one divided by 2. Then 7,200 divided by 2. It's 3,600. So 23,000 divided by 3,600. Is equal to 6.38 times. Then receivables period we need to calculate. Is equal to 365 days divided by receivables turnover. So therefore 365 receivables turnover we have obtained 6.38 times. Therefore, so we take the values 365 divided by 6.38. So is equal to 57 days roughly. 57 days. Now we have obtained what is called earlier inventory period and now receivables period. Therefore, operating cycle we can calculate in the first part. Operating cycle we can calculate as 6 calculation. Operating cycle is equal to inventory period plus accounts receivable period. We have calculated. It's very easy now. We know inventory period. It's given 111.3 days plus accounts receivable period, what is known as 57 days. We add together, it's 160 days, 168 days. So we know now operating cycle 168 days. It means that once the firm sold goods, now then an accounts receivable takes proceeds of sales, takes altogether 160 days to the firm. Then once we have calculate operating cycle, next question is that what is known as the calculation of the cash cycle. Second question, the second part of the question, we go to the question again. Second part of the question, the cash cycle of the above company. To calculate the cash cycle of the above company, we know what we need. First of all, we need payables turnover. First of all, we need to calculate payables turnover. Payables turnover is equal to, we know that, cost of goods sold divided by average payables. Cost of goods sold, of course, given is 16,400. Average payables, we go to the sum. It's here. Accounts payable 1,500 plus 2,000. So therefore 1,500 plus 2,000 is equal to, so 16,400. So this one 16,400 again I write. Then we need to come for 1,500 plus 2,000 divided by 2. It's 1,750. So therefore 16,400 divided by 1,750, we obtain roughly 9.4 times. 9.4 times. Therefore, with the same, now we need to calculate with this what is called payables period as well. Now we calculate payables period. In the payables period, we know that payables period is equal to (365). We need to divide by average payables. So 365 days, it is days, divided by what is called, we have obtained 9.4 times. So therefore the answer would be 365 9.4 times. So it's roughly 39 days. 39 days. Now, so we can calculate now what is known as with this information what is called as cash cycle. Cash cycle is equal to operating cycle minus accounts payable period. We have calculated operating cycle in our example. We worked it out. Operating cycle 168 days minus accounts payable period. We have calculated now. Accounts payable period minus accounts payable period. We have calculated accounts payable earlier. How many days? Receivables, operating cycles, payable turnover, accounts payable period. We need to calculate what is the account payable period. 39 days. 39 days. So therefore cash cycle is equal to 168 minus 39 days. It's 129 days. It means what? You have to have what is known as the interpretation ability in the sense that on an average there is 129-day delay between the time we pay for merchandise and time we collect from the sales. Now you understand the calculations. It's easy. So therefore, this is that we have calculated. Again I am going back. First of all, you need to calculate inventory turnover. Then after you need to calculate inventory period. Then after you need to calculate receivables turnover. Then that you need to calculate receivables period. And finally, so you have obtained what is known as operating cycle, and then thereafter cash cycle. Operating cycle and cash cycle. So then in the question you will find another part is there. Identify 3 alternative current asset investment policies and depict how those policies affect to liquidity, profitability and risk. If you go back to the that previous slides, so we know that there are 3 policies: aggressive policy, then that moderate, and then conservative policy. Most optimistic, then that average and pessimistic. Therefore liquidity position you have to analyze with relation to the 3 alternative current assets policies of the firm. Then again profitability you need to analyze in line with the 3 current asset management policies. Then that you need to consider under 3 scenarios risk of a company. So therefore that we have completed this part. We go to the discussion question number 2. Discussion question number 2. Discussion question number 2 is related to the capital budgeting. Now in the capital budgeting we have discussed at length the capital budgeting. You do remember. Under the capital budgeting, what that we need to do again here. This is advanced corporate finance. We have been discussing how the that estimation risk. Then we know from in the beginning I have been discussing in case of capital budgeting, what is forecast and risk in capital budgeting, why it is concerned for a financial manager. Now this is related to that estimation. So this is what if analysis. What happens if something change? Forecast and risk is happening. How? Our estimations are, managers' estimations are not always correct. So therefore, in the basic approach of our discussion is that when estimating cash flow and NPV estimates involves asking what if questions. So therefore, our goal is to performing whatever the analysis to assess the degree of forecast and risk and to identify the most critical component of the success or failure of the investment. So therefore, we have been discussing estimation risk, forecasting risk. Say wrong way, managers are forecasting figures. That is estimation risk. When that say exaggerated figures forecasted, when capital budgeting decision is taken to be implemented, if the expected results not being achieved, what would happen? So whole capital budgeting decision process, whole capital budgeting decision process will be in trouble. So therefore, it's very much clear when that financial managers are engaging in capital budgeting, forecasting risk should be minimum in the case. So therefore, we have been discussing the basic problem. Now, while evaluating this NPV estimates, that is the basic problem. Because once that finance manager completed the calculation, you need to check it again and again. Now, therefore, forecast risk, the concise answer is that the possibility that errors in projected cash flows will lead to incorrect decisions. Also, estimation risk. I repeat it, the possibility that errors in projected cash flows will lead to incorrect decisions is the estimation risk. It is important to the manager because manager must consider very carefully not to make a mistake or not to make any error. If errors are making, we know what would happen. Why? He is concerned for a finance manager. Finance manager is a person who is driving the company in terms of finance. Then with the wrong estimations, if the capital budgeting decision is taken, what would happen as a result of that? Company will become bankrupt. because all financial decisions are taken upon this that estimations, because whatever the that capital budgets are generating, it will add to the shareholders wealth. Then we go to the second section. We'll read it first. A project under consideration costs 750,000, has a 5-year life and has no salvage value. Depreciation is straight line to zero. Depreciation is no need to given 150,000 per year. The required rate of return is 17% and tax rate is 34%. Sales are projected at 500 units per year. Price per unit is 2,500 rupees. Variable cost per unit is 1,500 and fixed costs are 200,000 per year. 200,000 per year. Now, what is expecting out of this simple sum? Suppose you think that unit sales, price, variable cost and fixed cost projections given here are accurate to within 5% level. It means that 5% can go down, 5% can go up from the existing level of production. So Roman number 1 is asking, summarize the relevant information in the above situation showing values for base case, lower bound and upper bound. Second one, then use the above information to calculate upper and lower bounds for these projections. Third one is asking, what are the best case and worst case scenarios in PVs. Now we need to solve this one. We know when we discussed how this kind of problem will be solved. We have a base case information, but we don't have information about lower bound and upper bound, but indication is given. That indication is here. What is called? Suppose you think that unit sales, price, then variable cost and fixed cost projections given here are accurate to within 5%. So we open again whiteboard. First of all, what is expecting? We need to summarize the information given here. So we summarize. So you are required to answer this question. What is called summarize the relevant information in the above situation showing values. So base case, lower bound and upper bound. So therefore we need to summarize then sums given information. Summarization of relevant information. So we have here three things: base case, lower bound, and upper bound. So we have information to write the base case. Again, you just refer while that I'm working to this information. Base case information is given over here. We need to write first of all unit sales. Then we need to write price per unit. Then variable cost per unit. Then fixed cost per year. So therefore base case information, unit sales, (500) units, price per unit, ₹2,500, variable cost per unit, ₹1,500, fixed cost per year given it's 200,000. Then so we need to go back again to the question. Here it is important. Suppose you think that unit sales, price, variable cost and fixed cost projections given here are accurate to within 5%. It means that it can be reduced from the existing level 5% or it can increase by 5%. So therefore it means that low bound means pessimistic. 5%. 5% of the unit sales is how much? 10% is 50. 5% is 25. So then 500 minus 25, sorry, it is 475. We summarize. Then price per unit is given 2,500. So 5% is that 10% 250. 5% is 125. Therefore, the price per unit is 2375. 2375. Then variable cost we need to obtain. We have 1500 in the base case. Now 5% is that 75. So therefore 1500 minus 75 is equal to 1425. 1425. Then 5% of the 200,000 is equal to 10,000. Then 190,000. Likewise, we need to obtain upper bound as well. Upper bound is 5% increase from the existing level, from the base case. So it's here 500. %5 increase, 500 plus 25, 525. 2500, then plus 125, 2500 plus 125, 2625. Then here 1500, then 5% is from the 1500 is 75. 1500 plus 75, 1575. Next one. So 5% is 10,000, then 210,000. 210,000. So therefore, we have summarized all information. Now, in the below, the sum is given what is known as depreciation value as well. Then we have shown the information base case, then lower bound and upper bound. Then Roman number 2. Then use the above information to calculate upper and lower bound for these projections. Now we need to go for calculations now. Information we have summarized. Information we have summarized. Now given 150,000 depreciation per year. So then we need to calculate what is known as cash flows under each scenario. We know that in my discussion I said we assign high cost to low prices and volume for the worst. We assign high cost and low prices and volume for the worst case or the lower bound, and just the opposite for the best case. So read it again, summarize the information, go back to the previous slides. I will give you another 10 minutes to memorize, then I will work it out. Let's move into the calculation. Now this is scenario analysis we are going to do. Now my dear Mr. Dharmaratna, now so lower bound and upper bound, now shouldn't variable cost, fixed cost of the lower bound and upper bound when calculating creditor, do we need to divide question? Yes, yes. In the answer in the questions, Kumarasiri, that is, calculation is right. Average creditors we need to obtain. Then Mr. Dharmaratna, now I summarize the information. Now please follow. Again I read it. Unit sales 500, price per unit 2500 in rupees, variables cost in rupees 1500, fixed cost 200,000. Now 5% deviation, let's say we go to, there's the information given like this. Suppose you think that unit sales, price, variable cost and fixed cost projections given here are accurate to within 5%. So therefore accurate within 5%. It means that go up and go down. 500 is middle. So therefore lower bound means lower bound. 5%, in the 5% it means that, so in the first case 5%, 500, it's very simple. 500, it's that 5%, it's that 25, no. Then existing 500 minus 25, lower bound is 475. Read the calculation, very simple. Second case is the same. You need to obtain 2500, 5%. Out of 2500, 5%. 10% is 250. Then divided 250, then 5% is 125. Then 2500 minus 125, 2375. I will answer that Mr. Kumar series 1, the next after calculating this one. So then variable cost 1500, again 5% less, it means 75 less. So less means 1425. Here 10% means 20,000, 5% means 10,000. out of the 200,000, then 190,000. Calculation is correct. Then upper bound. So from this base case, more, 5% more. So therefore, again you need to that say 500, 5%. Out of 500, 5%. It's 25, no? 500 plus 25. So upper bound increase to the 525. Likewise here 125, then 2625. Here 1500. So 5% is 75. Then 1500 plus 75. 1575. Then here 10,000 fixed cost per year. Then 200,000 plus 10,000. 210,000. Clear? So we need to now go for the calculation. This is the information. Still that we did not calculate. Now we need to go for calculation. Scenario analysis. We need to write here scenario. Then we need to write again unit sales. Then we need to write unit price. Then unit variable cost, fixed cost. Then finally we need to calculate cash flow. Yeah, calculations are correct. I double check. Don't worry. We go ahead. Now cost has been increased. So in the upper bound, know that this is a hypothetical example. Only the upper bound. Right, lower case, variable cost must be reduced. All costs. So scenario again, base case, then let's say we take that in middle here upper bound means best case. Upper bound means best, more pessimistic. Best case. Then lower bound means worst case. Worst. Pessimistic. Three cases. Here now we need to that now apply the information. Unit sales. Here we go slow. 500,000. Correct? No? Base case. Best case. Unit sales. 525. Worst case. It's 475. Now we have obtained unit prices in rupees, base case, in the example 2500, best case 2625, worst case 2375. unit price that we have given. Then we go for variable cost, fixed cost. So our unit variable cost, say 1500, 1425, 1575. Fixed cost here, we know it's given here 200,000. Here now, this one 190,000, and then this one 210,000. Now you know how to calculate cash flow. Cash flow calculation we have done early. You need to take unit price, then you need to know that multiply by number of units, then you need to deduct variable cost, fixed cost, then after taxes and depreciation. Finally you need to add back the depreciation. We have done those earlier. So your responsibility is to calculate now under each scenario what is known as cash flow for this project evaluation. You are very much aware how the calculation is. You need to write in rupees. You check, I will write. Under the best case, cash flow for the project analysis should be 249,000. You check with your calculations. Second calculation, under the best case, it's 341,400 is the cash flow. Check it with your calculations. Under the worst case, it's 163,200 cash flow. Now, so it will take time for you to calculate these cash flows in the examination point of view as well. Now, discount factor is given in the sum. Please go back to the sum. Here, required rate of return is 17%. Tax rate is 34%. So therefore, now we need to go for calculation now. What calculation? Under all three scenarios, we need to calculate what is known as net present value. So cost of capital is 17%. 17%. You have studied annuity factor as well. You have annuity tables with you. You can directly take the values now by taking that project's lifespan is for 5 years. Under the 17%, you can go for what is known as 5-year annuity factor for 5 years. You locate it's under 17%, 5-year. Annuity factor, I'll give you 3.19935. I'll give directly because it's a 5-year project. It's a 5-year project. Within one step, you will be able to calculate NPV of these 3 scenarios. We go to calculate now. What is the first one? First one, base case NPV value, net present value, is equal to, what's the initial investment? Initial investment is 750,000 of the project cost. Then we need to plus, because we are going to, this is the cash outflow in the beginning. So cash in close of the project we found here 249,000 multiplied by, this is for the future, we need to obtain present value, then we need to multiply this one by 3.19935. Final value would come, you calculate it, final value would come as what is known as rupees 249,000. Now under the base case, still, sorry, it's not 249,000, I'm sorry. So we need to calculate that 249,000 multiplied by the 5-year annuity factor to obtain the present value, to repeat it again. And then you need to add minus 750,000. Finally, you will obtain NPV as 46,638. Very right. Then we go to the best case. NPV. Same thing that we need to repeat. It's minus 750,000 plus we calculated cash flows 341,400 multiplied by again same annuity factor. Best case NPV must be more value. Therefore, this one should be $342,258. Correct? Then we go to the worst case calculation. It's again minus 750,000 plus. So arrived value of calculation under the worst case 163,200 multiplied by 3.19935 is equal to rupees. It's minus value is coming, you check it, 227,866.07. It's minus value. Now you see all three scenarios. We have calculated NPV values. Under the best case, NPV value is the highest, 342,258. Under the base case, it's 46,638. So under the worst case, minus 227,866. So now, so what the question again asking from us? Then use the above information to calculate upper and lower bound for these projections. Then upper and lower bounds we have calculated. What are the best case and worst case scenarios in PVs? We have calculated not only best case and worst case, all three, what is known as base, worst, best. Now, along with that, now you are very much aware of this information. So, we need to calculate, we can calculate some more things as well. What is called, going for that time in accounting break even. Accounting break even. I'm also interested to discuss with you accounting break even, because it is also important. Accounting break even. Now, how that we are going to calculate accounting break even? What is our fixed cost? Our fixed cost is 200,000. Base case. It means we have 200,000 rupees in cash to cover fixed cost. So under the base case, then that we need to consider what is known as each unit contributes how much towards covering fixed cost. So what is called unit sales price in the base case is 2500, base case is 2500 minus now what is called 1500 variable cost. Variable cost is 1500. So therefore we have how much? 1000 rupees to cover fixed cost. Therefore what is the accounting break even? Very simple. Accounting break even, you have studied with me. Accounting break even. What is accounting break even? Accounting break even, that is that. So we need to calculate accounting break even. It means accounting break even is 200,000 in the base case plus we have made depreciation amount per year, it's 150,000. This one we need to divide by what? This one we need to divide by this 1000. Therefore, now we can calculate the value as you just divide it. Say 350, it is coming as units. It's coming as units. Right. Now we have calculated what is known as accounting break even as well. So therefore today we have discussed or we have reviewed what we have learned earlier in relation to the what is called working capital management, calculation of the operating cycle and the cash cycle, and thereafter we went for calculating what if analysis under base case, best case and worst case, what is known as NPV calculation, scenario analysis. Then you can judge, you can learn how our that calculations are correct, and when the company is operating at the base case or the worst case or the best case, NPV is the highest, and what is the break even, accounting break even number of units. So therefore I think that you have cleared your minds what we have discussed earlier in my sessions. Now to brief you about today's test, within another 5 minutes time test will be open. That is multiple choice questions. This type of comprehensive workings will be coming for the end semester examination. You need to prepare by now. Please go to the lecture slides. Please go to that PowerPoint slides that we have uploaded and learn by heart. Then that you are going to gain a lot. Then second part of today's session, 1 hour we have allocated to write answers to the multiple choice questions. You take 5 minutes break and fresh up your mind. With an open mind, please access to the internet and to the LMS. Please do the what is known as the online test for the advanced corporate finance. Apart from that, next week, those who have not done the presentation on capital budgeting, everyone should complete that assignment. Presentations, either physical or online, because it carries marks. So I stop from here. I wish you all the best for the today's online test. Thank you.